A firm's primary objective is to maximize its shareholders' value. The principal way value is increased is by investing in projects that earn more than their cost of capital. Chapter 10 will be about the cost of capital of companies. For this chapter, we'll discuss on the overview of the weighted average cost of capital, the basic definitions of the different cost components, and the first of the three cost components, which is cost of debt. In taking on new projects, it is required to find the cost of capital. So what is cost of capital? Cost of capital is the required return necessary to make a capital budgeting project. It is typically the weighted average of a firm's cost of debt and cost of equity blended together. Cost of capital metrics is used by companies to internally judge whether a capital project is worth the expenditure of resources. For the investors, it is used to determine whether an investment is worth the risk compared to the return. Cost of capital represents a hurdle rate that a company must overcome before it can generate a value. It is used extensively in capital budgeting process to determine whether a company should proceed with a project. It is important to note that a company's investment decisions for new projects should always generate a return that exceeds the firm's cost of the capital used to finance the project. Otherwise, the project will not generate a return for investors. Many companies use a combination of debt and equity to finance their businesses. And for such companies, the overall cost of capital is derived from the weighted average cost of all capital sources, widely known as the weighted average cost of capital. Weighted average cost of capital is often called WACC for short. Basically, WACC is a way to calculate the cost of capital for a company. WACC takes into account the cost of debt, cost of preferred stocks, and the common equity. These three are called capital components. Capital component is one of the types of capital used by firms to raise funds. The formula for WACC is comprised of the three major capital components. Breaking this will have percentage of debt multiplied with the after-tax cost of debt. In symbols, WD times RD quantity 1 minus T plus percentage of preferred stock multiplied with the cost of preferred stock. In symbols, WP times RP plus the percentage of common equity times the cost of common equity. In symbols, WC times RS. RD is the interest rate on the firm's new debt or the before-tax component cost of debt. RD quantity 1 minus T is the after-tax component cost of debt, where T is the firm's marginal tax rate. RP is the common component cost of preferred stock, found as the yield investors expect to earn on the preferred stock. Preferred dividends are not tax deductible. Hence, the before and after tax cost of preferred stocks are equal. RS is the component cost of common equity raised by retaining earnings or internal equity. It is the rate of return that investors require on a firm's common stock. RE is the component cost of external equity or common equity raised by issuing new stock. WD is the target weight of debt. WP is the target weight of preferred stock. WS is the target weight of retained earnings or internal equity. WE is the target weight of a new common stock or external equity. WACC is the firm's weighted average or overall cost of capital. The weights are the percentages of the different types of capital the firm plans to use when it raises capital in the future. Cost of debt, or in symbols RD quantity 1 minus T, is the first of the three major capital components. Before tax cost of debt, RD is the interest rate a firm must pay on its new debt. After tax cost of debt, or RD quantity 1 minus T, is the relevant cost of new debt, taking into account the tax deductibility of interest. This is used to calculate the WACC. After-tax cost of debt is lower than its before-tax cost because interest is tax-deductible. After-tax cost is used to calculate WACC because we are interested in maximizing the value of the firm's stock, and the stock price depends on after-tax cash flows.